biggest loss is I listened to one of my friends back in the days when he told me, no, like if I turn on this and I swipe right, you will hear bing.
Yeah.
And I would, like $274 would come into my account. Doing with stocks. And like, stocks is gambling, but you do that with real estate. No. People come in to real estate, where people come into the stock market, think this is a quick thing. I only trade for 30 minutes per week. Never listen to other people's advice. 42
On the
days.
43rd day, if the market drops,
I don't have to do anything.
You don't have to do anything.
Name a stock that you think is the most volatile. You don't want to own it long term, but you know it's the most volatile. Do people buy real estate and look at it every day? How much it go up or go down? But people are doing it with stocks.
If you are disciplined, this doesn't feel extremely risky.
Those are the things I look at, the ratios, make sure not over leveraged, but we all know Apple has a lot of cash.
Guys, do not quit this podcast and start doing options trading, because we are going to talk about risk as well. If you have been following my channel, you know that I am a long-term investor. I invest in real estate, I invest in stocks, but I really feel that I need to learn a little bit and not be a complete skeptic when it comes to short-term trading, when it comes to day trading, when it comes to options trading. I honestly don't know a lot about that, and therefore we have Cody here today, who's joined our channel for the second time, because the first time we got a little bit all over the place, but we'll try to narrow down on the basics of options trading today. He's a 7-figure entrepreneur. He's really amazing. I've learned a lot. The last time we met, I was on his podcast as well. If you have not watched that, I'll highly recommend that you go to the description and watch that podcast. It was on Wealth Busters. Cody, thank you so much for agreeing to do this. And I'm looking forward to learning from you, what options trading is and how to do it.
Yeah, good intro, and happy to be here to create and give the most value to your audience.
That's awesome. So just tell me a little bit about you, the audience. How long have you been doing this and why?
Yeah, so I'm an immigrant just like you, but I came to Canada at the age of 18 in 2009. And I studied graduate as an engineer from University of Toronto. I'm good at engineering, but I found my true passion was in finance, even in school. So I study and stay behind classes at night to learn about accounting, corporate finance, corporate behavior, all that good stuff. I still work 6 years of my full-time job at Honda, Canada, as a project engineer, save up enough money to buy my first property to fund my trading account. And by 2019, that's when my trading profit exceed my full-time income. And for that 6 years, I was working 400 to 800 hours of overtime at work, right? So I really started investing in stocks in 2011, 2015 to 2017. I tried day trading, crush, succeed, but it's too much time commitment, and really start settling on our strategy right now since 2018. And we're not going to show the full thing, but I'll give you guys the beginner stuff of it, just to get people from don't knowing about stock option, only know about stock to know about option, to from zero to hero in stock option.
Absolutely. For anyone who is watching this who don't know about trading at all, like they only know about putting into S&P 500, they probably put a little bit into some of the index funds, mutual funds. They're all long-term strategies. So if you can explain the difference between first day trading and doing that long-term, like investing in forgetting for 30 years for retirement kind of a strategy, what's the difference there? And then we go into, do the segue into how is day trading then different from options trading?
So day trading is a full-time job. Don't let anyone tell you otherwise. Okay. The reason is because even if people said they spent 15 minutes per day, they still have to wake up 2 hours ahead to read the news, have a plan, a logbook, and then do the trading. Sometimes if they lose up the day, they might go back and revenge trading if they're not trained well. And then afterwards, you still have to review what have you done today that's right or wrong. So don't let anyone fool you. Day trading is not a full-time job. I did it for 2 years as my second job. That's day trading. Now, option trading, could it be day trading? It could. Day trading just means that you are getting in and out of a position within the same day. Now, can I do the same thing with option trading? I could, but our strategy is more towards what Warren Buffett has been doing, which means is that we're happy owning the stocks that we want to own anyway, but now we could do it at a cheaper price. So instead of you go out and buy, for example, for the sake of example, we use Apple stock. Apple stock, I just checked right now, is 172. If you want to buy Apple stocks, but you don't want to buy at a market price, you can go and use option strategy to buy Apple stocks, agreeing to buy Apple stocks at 162 or 160. Could be 5, 10%, or even 15% cheaper. And you get paid upfront to agree to buy something you want to buy anyway, but not at a market price, much cheaper.
Why would you be paid for that?
Exactly. I said, why do you pay insurance?
So
Why do you pay your car insurance?
Who is paying that to you?
Just like there are few people,
Right.
few category. A very small amount are the gamblers, the day traders. They just trying to bet if the market's going to go down or go up. They buy a directional bet.
Right.
Very small amount, but the bigger amount is actually from the institutional, like the big banks. For example, any hedge fund or any institutional, even ETF, mutual funds, if they invest in Apple stock, right, they don't get paid enough for Apple stocks to go up, but they get yelled at if the Apple stocks go down too much and hurt their portfolio. So what do? They buy something called a put option. That's the most efficient, one of the most efficient way to hedge their portfolio. They buy an insurance. If the market really goes down, we know that this put option is going to save us from anywhere. Let's say if the market, Apple stock drop by 20%, anywhere more than 2% drop, they're going to be protected by it. So the big money are looking for more stability, less volatility, because that's what their investor wants.
And you are that protection. So you are giving that
We
protection.
are selling that protection
Correct. So
to
that
the big
makes sense. You are
institution.
almost like, like you said in the last podcast, you are almost like an insurance,
We're the
person who-
insurance broker, yeah.
So they're saying that, okay, as long as you make money, that's good. If it hits a bottom, let's say 160, I'll buy that irrespective of whether the stock goes to 150 or not. And that's why, you get saved. And therefore you pay as an interest till the time that happens. That's what it is, right?
Yeah, if it goes below 160,
Right.
you are buying at 160 regardless.
So
If
that's
it goes
the
to
risk that you're
zero,
taking. Okay.
you start buying at 160. But that's why the fundamental analysis of knowing that you really want to own this stock for the long term is the number one step. And that's why I use the example of Apple, because Warren Buffett owned 40% of his asset in Apple, right? So that's why for beginners, just look at who's doing it pretty well for the last 60 years and, learn something from that and benchmark from that instead of trying to invent something I think no one else thought about.
That makes sense. So like, is it as easy as it sounds? As in, it just sounds like, okay, Apple is a good stock. Let's do 160, but there could be a point where you lose money. What's that point? Like if it goes to 140, 130, like in COVID, imagine, a pandemic hits today. And we are at 172, stock market, the entire thing, falls down by 30, 40%. And you are, at 160, you're, striking. So like, is that when you lose money in this?
Very good question. So if people come, there's two sides of this. If people come in and say, Cody, I want that money getting paid up front as a cash flow. I have no intention of buying this Apple stock. They can get in trouble. But if you're coming from the standpoint where like, Cody, all these premium, all these money we get paid up front as an insurance broker, I just pocket change for cash flow. But truthfully, I want to own the stock for the long term. And now I have a chance to buy it way below the market price. And I'm okay in the short term of the fluctuation because no one has the crystal ball, not even Warren Buffett. So if you buy it at the 10% cheaper, it still goes down even more. Guess what? You're much better than the people who bought it outright at 172. So that's an argument. But doing that strategy on a stock you don't want to own right away or you need the money right away, That's not the right strategy to
But
use.
how much money are you putting in that? Like, because you're not buying the stock outright, right?
Yes.
Like, how much money do you need to invest? Let's say you want to buy 100 shares of Apple. 172 is what you can buy it right now, but we want to buy at 160. So we put a put. You said
You sell a put option.
sell a put option at
Yeah.
160. So how much money do you invest to
You don't
do
invest
that?
anything.
Okay.
But if you're smart enough,
Yeah.
always keep enough money to buy 100 shares of Apple
So that's
on the side.
$16,000 if it drops
Correct.
down to. Okay, that makes sense.
'Cause
Okay.
the way you think about it is when you pay a car insurance or you pay a home insurance, at any time you can make a claim to this insurance company. So the insurance company better have some kind of calculation knowing what's the percentage people are going to claim and always have the money ready.
Yeah.
Right. And now if you don't do that, the insurance company is going to go bankrupt.
Okay.
Right. So same thing. Whenever you sell a put option, you better have 100 shares of that money sitting aside, ready to go, because that can happen anytime.
That makes sense. That's what gets people into trouble. Not wanting to own the stock.
They're short-sighted, greedy, just want the cash. They don't want to own the stock. Just like, this is free money.
Yeah.
Nothing's free, right?
Yeah,
There's
that's
always
true.
a risk, but
There's
you
always
just
a
have to
risk,
know
yeah.
it, right?
Awesome. Can you show me on your phone? You know how do we do it?
Now let's go for it. Let's go for it. This is gonna be a fun ride.
All right. First of all, which platform is this?
This one is, let's see if it Interactive Brokers.
Interactive Brokers. Okay.
Interactive Brokers. Again, I don't get sponsored by them. Okay. You can use whatever you want. You can use all the other program. The reason why I use Interactive Broker is because it's one of the most cost efficient way to transact stock option. So instead of paying $15 per trade on big banks, here's about $1.
Okay.
So, and it's quite comprehensive. This company has been funded in 1978, has been managed billions of dollars, and all the hedge funds a lot of them use this platform again. So,
got it. Okay, perfect. Yeah, let's do it.
Cool. So, you see, this is roughly money in my account, right? We go to watch list, right? Said and done. Again, that's not what we're introducing today, but we're going to introduce what we call a wheel strategy. That's how you can buy a stock you want to buy anyway at a cheaper price and getting paid to do that. So again, none of these are stock advice I'm sharing here, okay? But we keep talking about Apple. So I assume that everyone, or I assume I personally want to own Apple. I did my research on it, fundamental analysis. I want to hold it for 10 years. Okay, cool. Now I come out and, you know, if you really want to go to details, I have financial instruments. You search up Apple, right? Apple's here. You add the stocks. You can look at the option. But I hit stocks. I already have Apple in my watch list, so it's repeating process for me. Now, what I would do here is I look at Apple. Usually what I like to do is I already did the fundamental analysis. I'm like, okay, I know I want to hold this long term because of all these numbers here. The PE ratio, 26, okay, is over 20, but it's a tech company. They're still growing. Okay, fine. You know, making sure they've been making money for the last 5 years. Those are the things I look at, the ratios, make sure they're not over leveraged, but you know, we all know Apple has a lot of cash, right? Now, the next step is I'll actually come to the chart here, and I'm going to turn my phone sideways. I'll look at the 5-year chart. 5-year chart. So the reason why I look at a 5-year chart is I want to know 5 years ago, where's Apple at? Okay, $41. Where's that today? 172. Now, there's a lot, it's not straight lines, all ups and downs, right? But I want to know within 5 years, it quadrupled. Okay, so that means this company has been doing well. People who ever invested in here did not pull out their money, even during COVID, right? It dropped from 80 down to 60, right? But then it's still higher than the previous high. I look at that and I look at last 1 year. Okay, well, it went from 158, kind of 172, as high as almost 200, but back down again. Now, why do I look at that? It's because there's something called support and resistance, and we want to buy at the low point because a lot of people think whatever comes up goes down. But for the short period of time, I want to enter at the low point. Now, if you look at what's the resistance, right? The previous low, it's about 167. And right now it's at 172, right? If you look at top left over here, 172. So 167 is a very good basis point for me to sell an option on. That's why I do that. Now, that's done. Technical analysis is done. Of course, there's more to it, but I'm just giving you a baby step to it. Now we're going to go to the selling option side of things. Okay, so now we come out. They just changed the platform of it. And let's go and hit. Okay. Let's go here. They just switched it on a few days ago. Apple options. Okay, that's not good enough. Option chains builders. Okay, so now that we pick Apple out of the option chain. Again, there's a fast way to get to it, but I'm just assuming everyone's the first time. Dumbest way to get here, right? So whole thing over here. Up top, AAPL. This is Apple ticker. What represents Apple? 172.67 is the current market price. And then there's a bunch of things here, but we're not going to get into it this time. But more importantly, the difference between stock and option is that stock option has an expiration date, which is this line I'm scrolling right now. So usually, I'm just looking at it for a blind purpose. I'm going to pick the 42 days, right? And the reason for that is I don't want to be so stressful. So the further out it is, the less volatility it is, right? So I pick 42 days. Okay, 42 days on this. Now that's expiration date. Now,
expiration date as in, after 42 days, it's done.
Yeah. So what that means is that if someone, for myself, right, my obligation is only 42 days. My obligation for a chance of owning, my obligation for the chance I need to buy 100 shares of the stock is only 42
On the
days.
43rd day, if the market drops,
I don't have to do anything.
You don't have to do anything. Okay, got it.
And
Perfect.
then I already collect the money up front, and we'll get to that.
Got it. Okay.
Right? So up top here is the expiration day. You can go as far out as 1,000 days.
Oh, wow. That's almost 3 years. Okay.
Almost 3 years if you want to. But, I really typically focus on 30 to 60 days.
sense.
So I use 42 days. Now, right in the middle, this is like the strike price here. Okay? So strike price is the price, the predetermined price that I agree to own the stocks at. Remember, we just show it in the technical analysis. 167 was the recent low. So I'm like, hey, there's a support there. So I'm happy owning it there because it was at 1.200.
Right.
If I can own at 165, 167 is what? Okay, 17% off. That's how I make base on that.
Okay.
Unfortunately, when I come to the strike price, I cannot see 167. There's only 165 or 170. So you know what? For the sake of this, I'll pick 165. I'm a little bit more conservative. I hide right below the resistance. Right below the support. Okay, so if I pick that, right now on this account, this is my public account. I actually don't subscribe to data. And there's, for people who doesn't know, data on a corporate account like this, $120 per month.
Oh, wow. Okay.
So if they have a personal account, it's like a few dollars. If you make enough trades, free. But the reason why I don't put on is because I don't day trade. I only trade for 30 minutes per week, right? So that's the case. I don't need real-time data.
Right.
It's lagging about 15 minutes. That's fine, right? So strike price 165. And now all these columns, the bid and ask. The bid is the price that if I want to sell this option right away, that's the price I sell this option right away.
Got it. Okay.
The ask price is basically the price that if someone wants to buy this option, they will buy it right away. So if I'm selling a put option, if I go right to the bid price, which is not showing here because I have a delay in data, but if I'm selling right away, I don't want to look at anything, that's the price.
Okay. Got it.
All right. The next one is last. Last column basically means, hey, last time someone buy or sold a put option, so strike price of 165, the value of that option is 2.74.
Sorry, what do you mean by that?
Exactly.
Yeah.
You're like, Cody, are you selling a put option to get paid $2.74? Are you nuts? Remember, if we backtrack a little bit, when I sell an option, right, I'm on the obligation to potentially own 100 shares of a stock.
Oh, that's per share.
So this is per share.
So you
And
get paid. So $100 shares will be $274 that you get paid
Yes.
for the length of 42 days, I'm assuming.
Oh, no, I get paid up front.
Oh, you get paid
Up front.
right
The
now.
moment
Oh,
I
wow.
swipe right, I get paid up front. $274 USD.
Okay.
If you do this on US stocks, they pay USD. If you do this on Canadian stocks, they pay you Canadian dollar.
Guys, do not quit this podcast and start doing options trading, because we are going to talk about risk as well, because it just could look like a cash grab here. Okay, $274 by doing this. So watch the podcast till the end. Okay. A disclaimer. Okay.
Yes, very important.
Yeah.
Now that we understand, if we want to transact this, right?
Right.
Let's say, Cody, I did my fundamental analysis. I look at my technical analysis, decide my strike price. Now I want to know if I agree to buy 100 shares of Apple at the strike price is 165. How much am I going to get paid? It's 2.74 times by the 100, because I'm controlling 100 shares from each option contract. Now that I set that base, you're like, Cody, what is this freaking delta thing?
Yeah.
What is that delta thing?
Yeah.
Right? Delta on the buying option side means that every dollar movement in the stock price, this is the ratio to how much the option price will move. Let me repeat that. So if there's $1 increase in Apple stock price, the option price would change by 0.264.
Okay.
Now, that's buying side. We're only on the selling side.
Right.
Selling side, the option of negative 0.624, 0.264, don't worry about the negative sign of this,
Yeah.
okay? Basically, that is the percentage of the chance based on the calculation of this option formula. Some people might know Black-Scholes formula, the nominal formula,
Right.
the whole background of how to calculate the price. They calculate it out based on the current situation. You have a 0.26%. So you times about 100, 26.4%.
Okay.
You will have to buy Apple shares of $165, 42 days out.
Sorry, is it a good thing or a bad thing? For instance, if someone is doing it with less knowledge and with no intention of buying, where the risk comes, right? So, like, can they not do it at 160?
Yeah, they can.
But
They can be more conservative.
Okay.
So there's no free lunch, right? So if you want to own Apple at an even cheaper price, you can do that. But if you guys look at the screen here, you will get paid less. Instead of 274, you will get paid 194. But your delta, the chance of having to own 100 shares of Apple, also goes down from 26% to 17%. So you can make all the adjustment you want. I can go sell at 155 if I want to. Right now I only get paid $1, right? But here's the thing. From my own personal experience, I want to at least get paid 1% per month. If I don't get paid more than 1% per month, why don't I just put my money in the S&P 500?
Makes sense.
So that's why I pick 165, because 165 I get paid about $274. If I divided $274 by, how much money I need to set aside,
Right.
which is 165 times by the 100.
Yeah.
Hey, that, and then divided by 42 days, I'm getting more than 1% per month.
makes sense.
And that's why it's worth it,
Makes
right?
sense.
You gotta make sure it's worth it.
Makes sense.
And of course, I'm okay owning Apple at $6, $7 cheaper.
Yeah.
From its all-time high of $200. Right?
Yeah, no, that makes sense. My only concern is that, people look at this and they're like, okay, let's make $100 today. And they do something, like that. And then something happens in the market, and that's where the risk comes, where you don't have the money set aside and you screw up.
Yes. So, again, like any investment has risks.
Yeah.
And I'm totally transparent and want you to ask me away on all the risks.
Yeah.
The biggest risk is, we have seen it, COVID happened when even Apple stock dropped 30%. So if someone don't have money to buy 100 shares of the stock, a few things will happen. Either they need to put in more money because their broker will ask for it. The broker is not here to save you. They just say, hey, risk is too high. You either put in more money, or I'm going to close this position right now. Whatever loss you can wipe out could be the maximum of your account. right? So that's where if you don't have the money to buy 100 shares of Apple stocks at 165 at any time, you are using something called margin. And you could get margin call when things like COVID happened. That's why I never done it. None of my students done it. I don't advise anyone to do it. Right? It's just stay on the safe side. 1% per month, 12% per year.
That's pretty good, right?
Yeah.
Compared to any other
30 minutes per week. It's not too bad. Right?
So, is there anything else that we need to know on this?
Yeah, like now that we established why we're doing this, my logic behind it.
That's
now you
good.
gotta go and say, hey, so Cody, how do you actually do it? So if I swipe up this, you will see that buy expiration day May the 3rd, 2024. Strike price 165. Put.
Right.
Is there anything wrong with this?
165.
Is there anything wrong with this, Nav? Remember, we're buying and selling. This is buying right now.
Oh.
So a very rookie mistake, but it happens a lot. So what
we have to do sell.
We have to do sell. So we go hit this, and now become sell.
Yeah, of course.
Even tell you your break even.
Yeah.
So because of a $274 you get paid, your real cost basis for owning 100 shares of Apple is 162.5. Even cheaper, $10 cheaper now.
Yeah.
Right. So that, and then you scroll down. And then you can look at all these probability, all that good stuff. But really, it's now you hit the order. Okay, you're assuming you already have 16,500 USD in your account. Okay, I hope you do. If you don't, now you hit order.
Yeah.
Okay, so everything's fine. Quantity 1. Remember, we introduced that one option contract controls 100 shares of the stock. So quantity 1 here means I control 100 shares. Quantity 2 means I control 200.
So the minimum that you can do is 100.
The minimum you can do is quantity 1. You can't go less than quantity 1.
Right. So you have to buy 100 shares minimum.
Minimum.
Okay.
And
this is for every stock, or is this stock specific?
No, for every single stock.
For every single
There's
stock,
only one option contract.
Okay.
There's no 0.5 option contract.
Makes sense. Okay.
I know for stocks you can do fractional share ownership.
On Wealthsimple and stuff like that. Yeah.
Wealthsimple, there's tons of other platforms allow it, but not an option.
Got it.
Okay.
Makes sense. Okay.
So one quantity, and then the order type, there's a few famous ones. There's so many here. My team use a lot of them, but really the simplest one I'm going to introduce here is limit. Limit means that, hey, Cody, I saw a $274. If I don't get paid that, I will not sell this option. Okay, so if you do that, then you put in, limit, then you put in the price here of 2.74.
Like we saw in the previous one.
Yeah, like 2.74. Do it like that. Right, but you're like, okay, Cody, I don't really need to make a difference of $1. I pay $1 commission. That's fine. I'm a busy guy. You said 30 minutes per week. Okay, I don't really care. Okay, so second order type you can do is called market. That means, Cody, I have no time. I know the spread on Apple. That means it's a very liquid stock. The spread is usually very small. Whereas if we go trade a penny stock where there's no one buying, no one selling, the spread is so big. So Apple usually is within $1.
Right.
Even the option trade shows within 1 cent, really, in terms of a stock price. So we don't worry about that. We just go on market, right? We pick market for the ease of it, and we say, hey, now you got to make a decision. Is like, do I want this to go overnight? For example, if I sell this option, if it's market, it'll probably get filled right away, especially on Apple. So time in for just means, hey, if it didn't get filled today, do you want to leave it until good till cancel? If you put good till cancel, you can go to sleep. You can go away. Age 80, this order will still be on. You're still on the hook.
Right.
Even no matter what you have a money in your account or not. So it's very dangerous. So I usually only put it to good till date.
Okay.
If I forget,
So that you are able to
tomorrow I have to
to
reset.
Yeah.
Right.
Got it.
So I usually leave it like that. And then attach order. This is more advanced. You don't have to worry about that. Like my student want to use bracket. We have a set profit, set loss going in. So it's totally hands off. Even I'm going on cruise, right, and all that. So now it's that. So we don't want to do bracket. We just do none. And then, the famous bar, swiping right.
Yeah.
So if I swipe right now, that will go through. So I'm not swiping right. I'm like pulling back. But
hopefully by the end of the podcast, it doesn't
no,
drop by 30%.
no, like if I turn on this and I swipe right, you will hear bing.
Yeah.
And I will, like $274 will come into my account.
Okay. That's
So
awesome.
we're not doing that.
Okay.
For people, if they want to look at preview, You can look at the margin
That's awesome.
requirement, all that good stuff. How much you're gonna get paid, all that good stuff.
I love it. I learned so much.
Yeah.
I've never seen this, right? So
Yeah.
I only look at Well Simple and there's options there and there's a bunch of, activity there and I just, skip it, right? I'm a busy guy, right? So that's awesome. I love it. Now, one risk is obviously if you don't have enough money and the stock drops and you just have to buy that stock. Is there any other risk? Is there a knowledge risk involved as well? Like I see a lot of people talking about this, that buy Apple stock, and then they just follow it without doing the technical analysis, without understanding what they're doing. Like what other risks that you see other than the obvious where you don't have the money to buy the stock?
So real estate, I'm using the real estate example. Do people buy real estate and look at it every day?
No.
How much it go up or go down?
Yeah,
but people are doing it with stocks.
Yeah.
Doing it with stocks. They're like, stocks is gambling. But do you do that with real estate? No. Now, this strategy is supposed to help the people who has the right mindset, long-term mindset, right? You're not happy with just making 8 to 10% per year, and you want to own Apple stocks. And the risk is that, hey, if you don't have money to buy 100 shares of Apple, you could get into trouble if the market turn really fast. Or your mindset change that you own an Apple share now, but Apple share goes down and you need the money right away. You might get pinched at a loss. That's the same thing with real estate.
Yeah.
Right? So those are the similar type of risks that we haven't eliminated based on individual stock trading.
Right.
And that's why, I know we're not going to talk about that, but that's why my set and done strategy is focusing on index S&P 500 only, because I don't want people to go out and pick stocks, because picking stocks is really hard. Why not we pick a good basket of them, right? Warren Buffett is willing to put all his money in S&P 500. Well, nearly all of it, 90% of it. If he passed away, he couldn't find a successor. So that's why from over the years, we have worked out ways to take out all the risks. And individual stock risk is one of them, because I share Apple here. I don't know where Apple's going. Not stock advice. Could it go down 50% tomorrow? Can it go up? Yes, it can.
I mean, it's individual stock. It's, if they make an announcement that's not conducive, it can happen, right?
And a lot of time people, of course, when they buy stocks, they want it to go up.
Right.
But Warren Buffett said that if you buy a stock purely because you think it's going to go up the next day, that's the dumbest way to invest. But most people do that, but they don't realize that the stock could go up and down while there's no change to the business itself. iPhone's still selling all that, but if they come up with a bad report, or Tim Cook, somehow something happened to Tim Cook, the stock will go down, but nothing changed the business. So there's a lot of short-term movements of the risk, right? So when people come in to real estate, where people come into the stock market, think this is a quick thing. Okay, then you should probably be looking at scalping or day trading. And you better have the time and the energy and to do it long term. But most of the people who are attracted to what I'm teaching is more like high income earners, or people have the mindset knowing that, hey, I just want to do better than the market. I'm okay to learn it for 10 to 20 hours, but after that's 30 minutes per week, I do not want another job. I have my main job making money. I want to be able to do this until I'm 80. Swipe right until I'm 80. I'm sitting on a chair, rocking chair. And that's what the people are looking for if they want that. You now learn a way to buy stocks at a cheaper price.
I love it. And the other problem is that I think there's a lot of discipline that's required, because if you win once, then you might get a little bit more confident, and then you start putting, like doing this on penny stocks or smaller stocks, and in hopes that, you get paid more. But then these stocks can actually, put you into trouble.
Very
right?
good. I'll give you an example.
Okay.
How people can get in trouble. So we just showcase Apple, right? So on my name a stock that you think is the most volatile. You don't want to own it long term, but it's the most volatile. Rivian. Okay. What's the ticker?
RIV, I think.
RIE.
RIV.
RIV. Okay. Rivian.
Yeah.
This one.
Yeah.
Okay. Now we have Rivian.
Yeah.
Let's go. Now you look at the whole thing, right? Today, S&P 500 go up 0.06%. Rivian drops 3%.
Yeah.
Okay, that's fine. Let's go look at the same thing with the same delta of 26%. How much would you get paid? Okay, let's go look at that fun part. Option, right? You go look at same thing, 42 days out. 42 days out, right? Roughly, we scroll here. Delta, remember that was like 26%. Now we look at 24%. How much will we get paid? You're like, Cody, you get paid $36.
Yeah.
But then we're only putting out 9.5 times by 100.
9,500.
So that means instead of getting paid 1% per month, we're getting paid 4% in 42 days. So that's about 3% per month with the same delta.
Yeah.
So a lot of people can fall into the trap, be like, Cody, I know what you're doing.
Yeah.
I love Rivian. I'm going to go do this on Rivian. But not knowing that, dude, are you happy owning Rivian for the long term? If you are just want to scalping, want to make quick bucks because you can make 3% per month, that's not the right mentality to use this strategy. So guys, if you guys want to use this strategy on a stock you want to own for sure, or on a very volatile stocks, this is exactly what can happen.
Yeah.
You're like, Cody, it was 130. I sold a put for 110. I'm like 20% discount, but the stock price now is $10.
Yeah.
You get a 90% haircut and you will never get it back.
Yeah.
And that's why so many people get hurt. And that's why our sign down strategy really to eliminate this kind of risk. Don't pick stocks. There's only one ticker, S&P 500. And we use similar strategy on it. Of course, there's more to it. We can use less capital than only 100 shares of the stock. Like we only need like 5,000 per trade, but the return we're looking at is like 1 to 4% per month.
Got it. So like if you look at S&P 500 right now, it's up crazy, like 30% of whatever 25-30% last I looked for the last 1 year. Like how much delta can we see on S&P 500? Like what's the additional return that you guys get when you do options on S&P 500?
I really want to just open my Discord. I'll show you all my members' results. For the last 1 year, my own account was 36%.
Okay.
And that was not all goes up, right? Actually, we prefer the market is flat. We don't want surprises. We're like an insurance company. If nothing changed, we make money. If things change too fast, we're worried, right?
Jitters, yeah.
So when S&P 500, according to NAV, you're looking at, hey, for the last 5 years, S&P 500 gone up, especially in the last 1 year.
Yeah, it's crazy up.
You guys are like, Cody, it was at, holy cow, it was at 3950. Right now it's at what? 5241. Because 30%, right? These are the time when there's sunshine and rainbow out there. Do you think insurance company can go sell a tornado insurance? No one will pay for it, right? So we actually make more money when everyone is having uncertainty in their mind. So right now is actually the time.
That's what I was thinking.
My team is very careful. That's why you see my account is fully empty.
Yeah.
Because I'm like, when everyone is all thinking about this is all great and good, rate is going to drop. I'm like, guys, there's like, have you guys seen the news? Like a lot of CEOs are dumping their stocks.
Yeah. Yeah.
So follow where the money is flowing. And I'm like, you know what? If I ever going to put on a position, I'm only going to put on 20% on my account. A little bit of money. I'm not being greedy. I make my good year last year. Meanwhile, my student on track to make 36% this year. But that's why I always caution them. Whenever you don't see anything in sight that you should be worried about, that means there's something wrong. But when you see a lot of things that you can worry about, the rate, where is this going and all that, that's the time when everyone is very scared. That's the time we actually go more aggressive, right? Just like what Warren Buffett said, go greedy when others are fearful, be fearful when others are greedy.
Right.
So we live that day by day, right?
Oh, that's awesome. That's such a, and like, at least, a skeptic like me, he didn't know anything about day trading. This, if you are disciplined, this doesn't feel extremely risky.
Yeah.
What a normal, long-term investor would think that, oh, this is extremely risky, therefore I'm not doing it. The way you say it, and if you're disciplined, I don't think it's risky if you have money in the account, right? So it's not for anyone. How much is the minimum that you need?
For our said and done strategy. So I think before I go there, I have to introduce this concept.
Okay.
So there's a fast, medium, and slow money. Everyone, all YouTubers are talking about buy and hold, ETF.
Yeah.
All that, 8 to 10% per year, dividend. It's very easy to talk about. I can talk about that. Now, that is the slow money. If you want to retire at 65, surely, but who knows what money will be worth at that time. You better make sure you beat the inflation.
Right.
It's because the government's keeping it down. Now, the strategy I just introduced throughout this podcast is what we call a medium speed money. Because every 42 days, I can rinse and repeat. I get paid about 1% to 4% per month, right? But I could get stuck in the stock for 42 days, for a year, for 10 years. Rivian, then you're forever, right? So that's a more medium speed money. But of course, you pick correctly. You don't want to get stuck with it.
Of course, yeah.
But then the fast money is where our set and done strategy come in. That's where we don't pick individual stocks, and usually we close our position every 10 to 20 days, and we rinse and repeat. So there's fast, medium, and slow money. Slow money is no brainer. Buy at this price, you pay dividend, ride the appreciation. It's like buying whole and the real estate. You don't do any renovation to force appreciation.
Yeah.
Medium money is kind of like you buy an underpriced house, you put some rental to it,
Right.
you turn over some tenant.
Right.
As a medium, can you take 3 months? Can it take 6 months?
Yeah.
If tenant don't want to move out, can it take 2 years? Maybe. So that's the medium money.
Makes sense. Yeah.
The fast money is where you flip houses, wholesale houses, or your active business like your mortgage
Right.
broker. That is our set and done strategy. But we make it so hands off that the whole system is in, so we only spend 30 minutes per week.
Per week.
So when you ask me, Cody, how much money do you need for the strategy we've been talking about throughout this YouTube, throughout this video? 100 shares of the stock. But how much money do you need for the set and done strategy that you don't have individual stock risks? Anyone could do it. Usually they're high income earners. $5,000.
Okay.
Because there we already have the risk mitigated. We don't have to own 100 shares of the stocks. We basically is that making a calculated risk trade that we know our win rate and is cash settled. So hope that answered your question.
No, that's good. That's good.
Yeah.
So, I mean, we talked about risks here. Like for you personally, what has been the biggest win? And then we'll talk about the biggest loss. And did you plan for that biggest win? Because the said and then, like you said, fast, medium, and you have strategies, you have technical analysis. Then COVID hits, and someone says something, Elon Musk says something, and something happens to the Tesla stock. You can't control all that, right? So if you want to talk about the biggest win, and did you plan for it, or it was just like mini planned, and then it just happened that. I know. I know where your question is coming from. Did you build up your trades into making that profit, or you just got lucky?
Right. I don't believe in luck. Yes, there's part of it where you're born and all that, but in trading, everything is quite calculated.
Okay.
I want to know my worst case and best case scenario. So my biggest win. Do you want to start with biggest loss or biggest win?
Okay, loss.
Biggest loss. What's my biggest? Oh, okay. Biggest loss is I listened to one of my friends back in the days when he told me that when Canopy stocks was really big. And he's like, Cody, the CEO of the biggest Canopy company in Canada has become an individual director for this company in Australia. Australia is about to go legal under Canopy. So I'm like, I don't know what you're talking about. But he kept selling me for 3 days. I'm like, what the? Are you getting commission on this? He's like, no. I'm just a person believe in it. So I put about like $10,000 in it. That's some money. I put in one Bitcoin, same thing. I'm like, okay, you put your name on it? Okay, I'll put in it. The moment I put in, it was at $1.2. So it's like penny stock. It's like, it's not even traded on the public. It's a secondary market. Put it in. And then I didn't look at it. Next year, I look at it like, hey, buddy, instead of 1.2, it's 0.56. Oh, like, what's going on? He's like, oh, I already exit at 1.4. I'm like, what do you mean? You didn't tell me? Like,
whoa.
So I'm like, I look at it. I'm like, 5,000. Okay, fine. That was the lesson I learned. It's only 5,000, but I learned from that is never listen to other people's advice. And I want to always have full control. I have no one to blame but just myself. And I would never make those kind of bet again on penny stocks or anything. Even though it could go to the moon, right? Imagine to convince someone like me, so calculate, what does he has to say to push me over the edge that for me to put in 10,000? I lost 50% of it. It was 5,000, but that lesson I can share with everyone now.
Imagine doing that on Bitcoin, right? So, like, you don't want to do that, right? So, and what was your biggest win?
Biggest win, again, it's nothing crazy. It's not like I have one of those, like 300% return because I'm bet on, I have a few friends that we know, like very famous on YouTube and all that. I'm very boring. So the biggest win for me was before Donald Trump was elected. Remember at that time, Donald Trump was talking about building walls.
Right, the market dropped. Yeah.
And everyone was thinking, this crazy guy's going to come in and do some crazy things. So the market was very unsure. Is it going to be Joe Biden? Is it going to be Donald Trump? COVID's happening. What's going on? At that time, the volatility index, so the volatility is that uncertainty in the stock option market went through the roof, so really high. I'm like, okay, I look at all the data. Historically, if Republican get elected or whatever, conservative, whatever, get elected, they still want the best for the U.S. economy. There's different percentage, but they all pointing to within a year from now, the market is going to always go up. After election, usually like very ones are certain. Afterwards, it usually goes up.
Right.
I look at the last 90 years. So I'm like, okay, so that's where I use the selling put option. I go sell on stocks I like, and I say, you know what? Volatility is so high, I can pay so much premium. I high so far away. And right after that election, the uncertainty drop, I collect all my money. So that was like $100K a month. Because if you have a big enough account, like 10% of doing nothing, even the stock price didn't change, but because of volatility, that's something that's very different than the stock market.
Right.
Stock market is just price.
Right.
Option market is volatility. So when everything is very uncertain, volatility is high. It's like when there's a tornado outside, you go and sell an insurance on tornado. You can sell it for 10 times the money compared to when there's a sunshine rainbow outside. So I sell a put option where there's tornado outside.
Right.
And the next day, tornado left, sun comes out. I'm like, hey, so do you guys want to spend 10 times less the money to buy my option back?
Okay.
And they're like, yeah, they already buy insurance anyway, right? So I basically just, close the position.
So just to, clarify. So let's say we are talking about, again, Apple, $172.
Yeah.
You think the volatility is very high. So you sell
I
a
can
put
sell it
option
for
at
160,
150.
yeah. Whatever.
So let's say 150, right? So you get paid till it hits 150, but it actually hits 150. You collect. That's what is happening, right? Or you're not.
No, the stock price didn't change at all. It's only after the election within that week.
But you got
The
paid
stock price didn't change.
because of the volatility.
Because they're like, okay, we're clear on who's the president.
Nice.
The world is still here.
Yeah.
U.S. still here.
Yeah.
What
you
changed?
got
Nothing
paid
changed.
more.
Okay,
Oh.
so now's Donald Trump. We're sure what Donald Trump's going to do.
Right.
He's going to pump the money into the market,
Yeah.
do really well for the business.
Yeah.
So nothing changed in the stock price.
awesome.
Meanwhile, because of the volatility difference, right?
But again, it could have changed. It could have dropped.
And that's where I
yeah.
look at a lot of the data, because I have like institutional data. I say
Right.
election year, every 4 years, what cycle is it in pre-election year, during the election year, and usually what happened after election. And then 80-90% of the time within 1 year, that 1 year goes up like 20%.
They have to.
So I'm like,
Yeah.
hey, I want to own Apple anyway. Okay, 20%. Okay, that's right at my strike price. Well, okay.
Yeah.
Worst case, 20% I own Apple for 1 year. Not bad.
Yeah.
And then that's how I take the calculated risk. And I never brag about it. Like only because Shay, the humble trader, kind of asked me about it. I'm like, I never thought about my biggest win. I don't really care. I want the boring stuff, right?
Yeah.
So nothing excited to see here.
So you're looking for 18 to 50% kind of a range.
Yes. Yes.
And as long as we hit that, we are okay, and we are not.
I don't care if it doesn't hit that. I'm okay too.
Yeah.
There's times where the market will allow you, like for example, right now the market is very greedy now. That's the time being very careful. Could I be wrong if I don't put a lot of position on? For the next 1 year, I only hit 10%, whereas everyone else hit 20 and 30%. I'm okay with that because I have my good years. But when uncertainty is high, that's when I make my money. And that's the way I think, in my opinion, the best way to make your money. right? Of course, there's consistency in it, 10, 50%, whatever. As long as I hit that, you know, I'm not like, I need to make 30% this year. That's the biggest problem people have, right? They think this is like an engineering thing. They think this is like a tech thing. Hey, I can tweak this 3% every month. No, it's never like that. The market is telling you, and based on our experience, sometimes you have to go more aggressive. Sometimes you have to be more conservative, and you have to roll with it, what the market is presenting you. But we have a strategy behind it, right? Probability behind it. But I'm still very careful how I deploy capital, because when options is present, so when the rate goes up, whoever have cash to buy, could be the best time to buy. And in my opinion, right now is a transition period in real estate,
Right.
where, hey, you guys want the price come down? The price has come down. You guys want a buyer's market? The buyer's market is here, right? So this is time where I would go heavier. That's why I pull a lot of money from my account. We just put in a letter of intent for a 97 unit. Multifamily in US, right? So there's times to do different things. I make my money last year, and I pull a lot of it.
And then put it into slow to medium.
Yeah, to
Slow,
do,
I would say.
because that's why I think they already make their money in the stock market. I don't know where it's going to go. It'll probably go up, but now the real estate is hurting. That's where everyone's very uncertain. There's a lot of mortgage coming out, renewal, whether it's residential or even commercial in US, right? Whether people exiting. That's when we jump in. That's where I see the opportunity cost, right? So that's why I always have real estate fund the stock option account, fund the real estate account, and I switch it around, right? And I have infinite banking, like policies, and all the, you know, the whole shebang of emergency funds, the line of credit. I have like 400K a line of credit just like open. I don't touch it, but if something hit the fan, I will take out 1/3 of it and say, okay, 100K. Right. So I never leverage to the max. I have a lot of credit and all that, but I never leverage to the max. But now's the time where I'm going to deploy a lot of my capital. Now I've been waiting for it, and I make my money.
That's great. That's great. So you said that it takes about 30 minutes a week. Is that for everyone, or in the beginning it takes a little bit of time because you're learning?
Good question. For a said and done strategy, for engineers or for someone with an analytical mind, you know, age between 25 to 60, they will learn it in about 10 hours. The reason I said that is because we have an analytical mind, and the way I built the course is really dumb it down so that people can follow the system and the criteria. They can make smaller tweaks, but the direction is there. The whole step-by-step guide I would just show here, I show everything there multiple times, right? So it's 10 to 20 hours to learn. And after that, if people can still get very excited, want to read on the news, it might take them longer, but they don't need to. Then after that, it's just imagine the same thing doing week after week, because you're like, okay, we know it's Apple stock. Okay, we know it's like Delta. It's the same. Do I have money? No money? Okay, put it down. Oh, I have money sitting aside. It's a good market, volatility. Okay, good. Is there any big news coming up? No? Okay. So, okay.
Let's just do it.
That's why it's 30 minutes per week.
Makes sense. That's great. Cody, is there anything that you feel we have not covered, in the sense that if there's someone new, you know, seeing, and you want them to not make that mistake, what's that one thing that you would recommend them when exploring options?
I'll just say, you know, be open-minded. Go consume content. Make sure the people you're following is doing exactly what they say, and they show a track record of it, and they are someone you want to become, or the lifestyle you're living is something you want to become. And do your due diligence, and you can start with a smaller account. If you want to do it all on your own, take this video, go do it. Just be very careful with that. But if you're someone who's like, Cody, I'm like you, if I want to learn something new, I don't have time. I don't want to lose money because it costs so much more because of a bigger account. No time, then you can potentially consider a coaching program. And that's only when a coaching program could make sense, because give you accountability, make sure you don't make the mistake, and they hold your hands, right? But other than that, they can do it on their own. Just be very careful of the risks we talk about, and don't be greedy.
Right? That's amazing, Cody. How do people find you?
Well, they want to find me, they'll find me, right? Go to the YouTube channel, Cody Ye Investing. That's CODYYEH Investing. And I'm on Instagram, I'm on podcasts, right? We have a Wealth Busters podcast, and
that's amazing. Cody, this was so amazing. Like, I learned this. I'm gonna try it. I know that you said that you don't have to if you, but I am gonna try it for sure, because I just wanna, experience it firsthand. But yeah, this is so exciting. Thank you so much for this.
Yeah, thanks for having me.
All right, man.
All right.